Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at DNA, and I'm joined here today by my longtime friend and colleague, Bram Gallagher. Bram, welcome to the show.
Thanks, Jamie. Always fun to be on the Data Lab.
Yeah, so Bram, usually when we are getting together to talk, it's because there's either some major economic event that's sort of happening or we have new forecasts to talk about. And right now, we're here to talk about the sort of mid-year outlook, our updated forecast for 25 going to 2026, and sort of rebaselining sort of what the expectation should be for short-term rental hosts, property managers, investors, the like. So, how do you feel?
Well, it's been a good year so far, an exciting year. As far as new economic sort of events that are happening, we've got plenty of those to choose from as well. So, it's definitely been a great year for trying to come up with forecasts.
Yeah, sort of a record uncertainty, a massive disagreement on the outlook. Are we going into recession? Are we not? Is the stock market down 20% or is it up? Like, I feel like any given week that we could have recorded this over the past couple months might have had a different sort of underlying tone sort of centered on it. And maybe I'll time us for a bit because things can change quickly. So we're sitting here last week of July 28th, recording. We just had the announcement of the new trade deal with the EU. We are sitting here at a record high of the stock market. We have seen some recent inflation data that has maybe paused some of the deceleration that we had been seeing, but there's quite a bit of disagreement between the Fed and the White House on the direction maybe that interest rates should be going, or at least how quickly we should be responding to sort of changing economic numbers. And then overall, and I get the sense right now, and I'm interested in your thoughts, that overall the economy is still looking, and it's holding up well. Like, we're still at very low unemployment levels, and we're still seeing pretty decent job growth that and is at least outpacing on population growth, and consumers are generally still spending. And maybe though we are seeing some clear deceleration there in terms of consumer spending and rates of spending around the country. So the run of show today, maybe what I was thinking is we maybe start with just a baseline of like what's happened in the first half of the year and how did that expectation, or how did our expectations vary sort of when we were talking at the beginning of the year. And then we'll talk a bit about the economy and what the sort of outlook says, at least as of today. And then maybe talk about the factors that are sort of impacting on current performance and the outlook. I know we've seen some pretty big movements in terms of pacing and the impact of lead times on pacing, how far in advance people are booking, and maybe how uncertainty is impacting that. And then we'll end on Bram's 2026 forecast to sort of get people excited and for the next 18 months. How's that sound?
Sounds perfect. Yeah, so the story of short-term rentals so far this year, and as you said, we did start out at a really good spot. Mark Zandi over at Moody's, I think, described the U.S. economy at the beginning of the year as the strongest in the world, and it continues. We still do have very low unemployment, as you say. We're operating pretty close to our potential output, I'm thinking, and it's reflected in the short-term rental market. So far this year, the year-to-date demand growth has been about 5.7%, and listings growth has been about 4.6%, and we have seen just ever so slightly higher occupancies as a result. So 54.9 was the occupancy for the first 6 months of 2024, and it's currently standing at 55.5. So we did suspect, or we predicted actually, that occupancy had hit that bottom last year, and it would be slowly creeping up. So that does seem to be holding. Price ADR seems to be growing as well. So far, the short-term rental market has been robust. It's been strong. It's showing some signs of maturity, but at the same time, it's also continuing to grow at a good clip.
So maybe I'll just pause you there. So if we think about the sort of outlook for just supply and demand, because those are two metrics we look at pretty closely and sort of our major inputs into, and obviously occupancy and AR, but also just major metrics that have been super volatile over the past like 3 or 4 years. Clearly, supply has been sort of decelerating. We're not seeing the supply growth rates that we saw at the beginning of in 2022 or 2023. What have we seen sort of the first half of the year? Like, I know interest rates have remained high, home values have remained high. Like, has supply come in better or worse than we were expecting?
Look, it's actually surprised me a little bit on the upside because, as you mentioned, the U.S. housing market is still pretty much in a deep freeze. Maybe even maybe even colder as of late. So interest rates do remain high. Prices maybe have leveled off, but they still have never really declined in a significant way after they went up markedly over the pandemic. But what we have seen is that, yes, since interest rates shot up starting in 2022, we've seen the available listing growth decline in response to that. And it reached a low actually at the end of last year. So 3.1% was the December year-over-year listing growth in the US. But we've seen something of a reacceleration this year. So, in fact, in June of this year, our available listings grew at a whopping 6.1%. And it's kind of graded up since then. Something else that I've been paying attention to is new listings. So that is, definitely an important part of supply growth is new listings. And whereas, they had been falling on a year-over-year basis for the past 11 months, but in June we finally saw about the first growth in new listings that we've seen in about a year. So that was exciting to see. So, whether it is people seeing the end of these high interest rates, because most economists are predicting at least one, maybe two rate cuts this year. Some of the really, really optimistic ones are expecting even more than that. The Wall Street consensus is always a little bit higher than, or has a few more cuts in there than a lot of economists expect. Those guys are always optimistic. If Donald Trump is persuasive enough, we might have more cuts to the rates. But in any case, people can start seeing the light at the end of the tunnel. They're also seeing, I think, that the people are still traveling. They still have strong leisure demand, and they're going to try to take advantage of that. So, we're getting some renewed interest in supply, which is, I think, really a good sign. Low supply has been really great for performance because occupancies have been able to stabilize and even go up a little bit in the first half of this year. But on the other hand, you don't want the market to be shrinking. You want to be part of a growing market, and luckily we're still part of that.
No, that makes sense. And I think it has been exciting to see some specific location types turn from seeing declines last year, like in urban areas, now sort of coming back to sort of positive growth, even while we're still seeing pretty weak growth in sort of coastal mountain markets, which I think is where you see a lot of those sort of more full-time investors where might be most interest rate sensitive as well. Someone maybe in pure time investor versus someone doing it part-time in an urban area. So, and the other question I had for you is you sort of mentioned occupancy being up in the first half of 2025. Now, when we look at the monthly data, essentially it's been 3 entirely different months of performance. Like we were up in January and February in terms of overall occupancy. We were down in March, up in April, and now we've been down so far in May and June. We know sort of volatility increased substantially around the and sort of Liberation Day, tariffs being announced, and so do you see sort of the trend that we've been seeing in May and June being more of your expectation going forward, where occupancy is down about 1% in each of those months? Or do you see us moving back more towards what we saw in sort of January and February, sort of pre-Liberation Day of and occupancy growing as we look into the back half of 2025?
Yeah, that's a great question too, because as you said, we've seen, generally speaking, the first 6 months have increased occupancy, but these last 2 months, May, June, have been down very slightly. It looks like July is, looking at some of the weekly data that we discussed earlier, it looks like July may end up in a similar place, and I'm expecting August to end up similarly, slightly down in occupancy. We had a colleague of ours, Camilo Rivas Schmidt. He was looking at Europe, and he noticed a trend there because Europe is getting blisteringly hot in the summer, and we see some of that demand spreading out from the hottest months into some of the shoulder months. Now, of course, that's largely temperature driven, but we saw something similar, and we talked about the expanding shoulder seasons back in 2023 when there was a lot of economic uncertainty, because you can look on the shoulder seasons not just for cooler temperatures, but also often for lower rates. So I believe that is not only are we going to see temperature highs, and we're both in Atlanta right now, so it is hot this year, but not just that driving, but I think this uncertainty itself may drive people to start looking to the off season for value to spread out the tourism, I guess, schedule a little bit. Therefore, we're going to have a little bit of a decline in occupancy during the very peak months, and that is, we're in the very peak months right now, June, July, August, the high season for sure. So we might see slight declines in unit level performance for those in those really, really good juicy months, but we're going to see offsetting increases to performance in the shoulder season. So that's what we've seen already this year, and I think that trend will continue as we move on the year. Now, of course, there's still a lot of unknowns. Consumer confidence has been bouncing around quite a bit lately. We do know that some of the economic indicators are starting to shift just a little bit. So there may be additional, there may be additional uncertainty. There may be additional economic worries at the end of the year that might tamp down consumption a little bit. But, right now, as it stands, that's my expectation, is that we will continue to see the whole year occupancy will improve, but we're going to see a little bit of dampening during the summer months and made up for in the shoulder seasons.
Yeah. So, and the other trend we were sort of looking at, and as we were talking at the beginning of the year, was sort of the impact of international inbound data and travelers coming into the United States. And I think we rolled back the tape of your sort of expectations at the beginning of the year. It was going to be sort of slight increases and maybe low single digits of international inbound to the U.S., probably slight increases international outbound to the U.S. from the U.S. And then I know a lot of both our expectation and other sort of prognosticators and expectations really changed in the beginning of the year, and with the sort of ramping up of commentary around the tariffs and some countries sort of pulling back on international inbound. So far, what have you seen as the impact of that on sort of U.S. short-term rental performance? Is it just, I think we had talked to, it's like 10% of overall demand. So like, hasn't been a meaningful impact of overall performance this year?
Yeah, if I wanted to get the exact numbers out, and the effect such as it is, has been, intensifying to some degree. But in 2024, in June, we had about 92.6% of all U.S. demand was domestic, 92.6. And this year it's 93.1. So yes, it's about a 0.5% difference there. Of the total supply has kind of shifted from sort of international to domestic. So we have seen maybe a little bit of a weakening, and you're right. We really saw international as sort of a slight tailwind, particularly for large cities, urban areas. This is where international guests really like to visit. It turns out it may be a tailwind for these markets. International travel was down 3.6% in total in June. But Canada, which is one of our larger origin markets, they have seen a sort of dramatic reduction. So whereas the whole world, about 3.6% lower, Canada itself, 35% lower. So more than a third. So the rhetoric about Canada and the sort of subsequent boycott actually does seem to be taking effect. If I was going to look at that same data that I just looked at, sort of that origin data, Canadians had made up 1.6% of total demand in June of 2024, now only about 1%. So demand is going up, but the shares of that international demand are shrinking. So far, we've seen domestic demand, be able to fill in the gaps. And it looks like it's going to continue to be that way. But if you are in one of these markets that relies on Canada, so you're on the border and you get a lot of visitation, whether it's in upstate New York or some of the main beaches or in Washington State, then you might see a more pronounced impact, because this Canadian travel boycott does seem to be pretty serious. And in addition to that, the Canadian dollar hasn't strengthened against the U.S. dollar in the same way that the euro has. So it's also relatively expensive for Canadians to travel to the U.S. as well. So both of those things kind of conspiring against one of our top origin markets.
Okay, that makes sense. And so maybe it's and to summarize, like it's definitely a headwind right now, but not causing any sort of major correction in performance. Is that a sort of good way to summarize it?
Right. Yeah. In fact, the effect on performance, is very, very small. It may be being made up for by an increase in domestic travel, for all I know, but that does have distributional impacts.
Yeah. Some markets that are winners, some markets that are losers based on their sort of exposure to Canadian travelers and their sort of migration south.
Right, exactly.
Yeah. All right. So that's sort of a good level set on current performance. Maybe now let's talk about the economy and what we're seeing, the outlook of the economy, because and as we sort of mentioned in the beginning, and if you were just looking at the stock market, you'd maybe think we were riding a roller coaster for the past 6 months.
Right. And you know what? A lot of people are going to be looking at that. It's so much easier. I've said this before. It's so much easier to check your retirement savings now than it once was. You don't have to go into the business section and check all your stock prices one by one in your newspaper. So people have been watching that, and while they're making travel plans, so it's that's a difficulty.
Yep. No, and it's definitely, I think, clear to people. And then also, and we know that the stock market isn't the economy, but it can be and absolutely have an impact on people's propensity to travel and spend money. The so-called wealth effect, and how that impacts consumer spending. And we look at there's a lot of factors I think we look at for forecasting and sort of judging the health of the consumer, not just consumer spending, but sort of job growth, unemployment rates, and incomes and the like. So, and baseline, and can you give me a sense of across all the market or metrics you look at on a regular basis, like how have they been doing in the past couple months? And what is your outlook for those metrics over the sort of near to midterm?
Right. And I think the fluctuations in the equity market really describe the uncertainty around the future, because the present performance, in fact, all the economic performance year to date has been very, very strong. So last month, for example, the unemployment rate, we were wondering about the unemployment rate. What's it going to do? And it went down a little bit from 4.2 to 4.1. So it's been staying around 4%, 4 to 4.2% for the last year. It continues. I know that's one of your favorite metrics to look at is employment, because everybody with a job is going to need to take a vacation. And we've seen really strong employment statistics. So about 150,000 jobs added. This conversely is going to influence the Federal Reserve's decisions about interest, because of all the data points, the first one that pointed to any sort of negative reaction to any of the policies so far, besides declining GDP, as we front-loaded imports during the first half of the year. But the other one would be that we did see a slight uptick in inflation in the month of June. It went up to 2.7, where it had previously been 2.4% in May, 2.3% in April. So, if you were to ask me, 2.3% inflation, is that good? And I'd say that's within spitting distance of the target. That's essentially as good as it gets, right? There's a little margin of error. But now 2.7, that's a little bit on the high side. And if it continues to increase, that could be more worrisome. As we saw in 2023, inflation can have a contemporaneous effect on spending. The price of everything else goes up, then people have a little bit less to spend on vacations today.
Okay. And so that makes me feel decent. And at least not and running for the hills in terms of and I might suspect that you're saying around the demand outlook. You did introduce in this version of the sort of outlook report a series of scenarios. And those scenarios went from essentially, it felt like varying degrees of bad, like how things could go wrong over the sort of next year.
There's
Is
a
that
couple
a
positive
safe way to
scenarios.
describe it?
No, there was a couple positive scenarios in there, but there is significant more downside risk. To your point, there's more downside risk than there is upside risk. But again, that's simply because we're doing pretty well right now. The economy is functioning well. So there's not really much more with a 4.1% unemployment rate. There's not a whole lot of people that we can go out and find and get jobs for, historically speaking. So, there's only really so much upward motion that we can do, but there's a lot of delicate things that could happen that may cause us to have lower growth. Hopefully with the EU trade agreement today, one of those scenarios, the worst case scenario is the worst case trade war. And this is when we would have the European Union start escalating its tariffs in response to U.S. tariffs. Both of those would start increasing in a cycle. This could have global implications as well. So that would have been a real moment for pause, I think, and reconsideration of policy. The 15% that was agreed on this morning, on the other hand, it seems to have, and it may not be the final word in trade, but it does seem to have given a lot of people some breathing room, at least some time to start considering, all right, well, how can we respond to these tariffs? Will we reorganize our production? How is consumption going to change? So it's not to the disaster level, but there will be economic implications that are going to unfold over the next few years. But again, we're in a very, very healthy spot. There's no particular I don't think that there's a strong risk of recession right now. I think it's definitely in the minority probability. Consumer confidence has been bumping around, but it's staying pretty close to that sort of 100 baseline that the conference board has as sort of a neutral outlook. It's a little bit tipped to the negative, but not a whole lot, not nearly as badly as, say, in the pandemic era, and certainly not as bad as when we had the Great Recession, where consumer confidence was much, much, much lower than it is today.
Yeah. So as we start thinking about our outlook for the industry, if I had to put you on the spot of sort of thinking about the chance of recession over the next year, what is the chance that the U.S. sort of dips into recession over the next 12 months? Where if you think about sort of long run average, like we go through a recession, maybe in 7-10 years, I think, and if you sort of do the math, like a typical year, like all else held equal, it'd be like a 17% chance of recession. Where do you think the economy is right now in terms of the chance that we sort of move in?
I think it's actually pretty similar to the long run because about that 10-15 range. And because we're sort of at these two things, we have policy uncertainty on the one hand, but we do have a lot of strength, momentum. We have positive inertia sort of going into that. So those two kind of offset each other. So right now, my personal judge of the likelihood of recession is not particularly elevated, but really more about the baseline. Even in some of our worst scenarios that Oxford has put out, that worst case trade scenario, I don't think it's strictly ends up in recession territory. I think GDP slows and I think even goes negative for a quarter, but it's not enough to drive the U.S. into a technical recession. And I'm sure that their probability of that worst case trade scenario has declined significantly since the announcement this morning of a trade deal with Europe. As well as some of the other trade deals that have also been struck with Japan and other countries as well.
Yeah, so you're feeling pretty good about the overall economic prospects. I'd say I'm a little bit more pessimistic at this point. I'd maybe like double that sort of chance of recession, maybe 35-40% over the next 12 months. Just given that, and and yes, we've got an EU deal. Yes, we've got a Tokyo deal, and we still don't have really clear certainty on sort of the environment that we're going to be operating under. Um, and like if you just look at underlying consumer spending, like we saw I would say a big run up in advance of the tariffs, like at the beginning of the year, like in Q1, and some of that sort of forward spending, forward imports, sort of led to the overall GDP decline in Q1. Subsequently, we've seen and maybe consumer spending and slow down pretty significantly in recent months. And so, yes, things are looking pretty good for the first half of the year, but I think a lot of that was sort of pull forward. And so I still have a little bit of worry on how robust consumer spending is going to be. And we had repayment of student loans come back. We have seen a sort of deterioration in credit scores, absolutely impacting and sort of car repayments. And we're not yet seeing any major increases in delinquencies, but maybe we're starting to see some warning signs there in terms of the health of the underlying consumer. So not yet. Yeah, where that I think we're going into recession, or even where I think there's greater than a 50% chance of recession, but definitely some worry there on what could happen for me on the back half of this year and into 2026.
Yeah, definitely, especially with that. The one big unknown to me that could have a really upsetting effect to me is inflation, and we haven't seen a whole lot of that yet. But uh, it does take time for these sort of tariffs to translate into consumer prices. So I believe, from what I've been reading, is that initially the price changes had been absorbed by foreign producers, but more and more this is being pushed on to importers, U.S. importers, and eventually to the consumer. So there is that. I think there've been some stirrings too about recent immigration policy. Now, that might be affecting labor supply, and that may impact prices in some industries specifically, since we won't be as open to trade to to fill those gaps should they arise. So there's definitely some uncertainty. A lot of things would have to go wrong, I believe, for the U.S. to pitch into recession. But on the other hand, there are a lot of things that could go wrong.
So maybe now let's start talking about the an outlook for short-term rentals. There is a broader sort of and what we see in the sort of current pacing data, and which may or may not be predictive. And then there's also sort of what we're sort of forecasting, sort of absent of the sort of pacing data. So give me a sense of just like, how are you thinking about a near and sort of longer term performance, and what are you seeing in the data set?
Pacing is it's a very used metric. It's a tool that is extremely popular for looking at future demand. It has been difficult to interpret this last year because of some of the changes to lead times that we have been seeing. So that has been the focus, is trying to understand and get my hands around some of the, what the pacing means with some of these lead times. So lead times, yeah, they went down dramatically during the pandemic. They bounced back in a big way in 2022, but have since been declining essentially everywhere as time goes on. And there's a variety of different explanations for maybe why this is. Occupancy might be a really important one. Is that occupancies have been falling for since 2022, and therefore people are feeling more confident that they'll be able to get the listing that they want when they want it. But in any case, yeah, this has definitely caused a shift downward in the median lead time. And within that, we can actually see, changes depending on where you're located or even how much you're charging. Budget properties, the lower end of the scale, budget and economy properties, those lead times have been declining more quickly. The luxury lead times have been declining more slowly. All of these divisions have seen a pretty significant increase in last minute bookings, though. So those are bookings made within, say, 5 days. Whereas it once was about 1 in 6 of these in, say, 2022. 1 in 6 reservations would be super short term. Now it's more like 1 in 4. So it's definitely gone up. I've heard anecdotally a lot of people noticing a lot of last minute reservations. Something else too is in the higher end. This is somewhat offset by an increase in very, very long lead times, so longer than 6 months. We don't see that increase everywhere, but we do see it a little bit in the luxury. And so what this does to pacing is that before about that 5-6 month mark, we are over predicting demand because of that big lump of early bird reservations that's increased. Then once we get into that about 6 month, our pacing is going to underestimate demand because we see this big missing chunk of reservations in that sort of medium term. And then finally, as we start approaching the date, we increase our prediction of demand using pacing until it finally meets with the true value as we get all these last minute bookings sort of coming in. So that is kind of something that we've got to adjust for, especially when we're looking, way out as far as months in advance. This can make it very, very, very difficult. So we're going to be relying on pacing, but we're also going to be trying to think about, well, what's the relationship of, this pacing and lead times that we're seeing? And also, what are the economic fundamentals that are going to be driving our performance, for the forecast? So that being said, we predicted through pacing that, this summer the occupancy was a little weaker. However, it does seem to increase noticeably by the time we get to October. And if we do see a big clutch, I guess, of last minute reservations for September, we may also see some sort of increase there. We'll see about that, but it definitely looks like the October, November, December, that off season is going to be going up. And that's going to give us a little bit more strength. And I should point out too that, the occupancy declines that we've seen these last months are not enormous. There's about 1% of occupancy, and that's off of, again, some of the highest occupancies that you can get all year. So these aren't really large declines in occupancy, not necessarily bothersome or worrisome. And we do seem to see that off-season theory does hold. So we are expecting demand to continue increasing this year, and occupancy as well to increase this year. And for that to hold steady into 2026, we don't have occupancy going either up or down essentially in 2026, but remaining flat as kind of the market achieves balance, and for the headwinds and tailwinds are going to even each other out.
Okay. So I'm feeling like I shouldn't feel too bad about the forward pacing data, that the lower booking lead times are maybe broader indicator of sort of uncertainty and not an indicator of overall weakness. So once you combine those two, and we sort of, and yes, we expect near term and occupancy to maybe be down in July, August, into September, but then and you look at sort of forward pacing in the fall, and like things are holding up actually pretty good. So
Yeah, I would say too, one bit of advice would be don't lower your prices too soon if you need to get that occupancy, because there are last minute bookers. Don't lower those prices too soon or too often. But of course, on the other hand, be aware of the dynamics in your particular market. Subscribe to AirDNA, for example, to get some context.
and maybe, and that's a good last question for you of like, and how much does this vary among the different markets that you forecast? Because, and we've been talking nationally, and I know you forecast at a market level as well. So, and are these sort of national trends sort of typical to the sort of markets that you're looking at, or do you see pretty big sort of dispersions in terms of overall market performance?
I would say the biggest division that we've got right now. So all of these markets are going to be responding to the broader economic dynamics, but I am starting to see some imbalances, and the division is really between sort of the large city and the resorts. So the resorts have been doing, they've been doing well. They're leisure focused. A lot of these drive to leisure as well, which is pretty big. So when you've got that sort of domestic substitution coming over, as far as the international is not coming in, but maybe more people are traveling domestically. Where are they traveling to? They're going to these resort locations. Now, on the other hand, in the urban and the suburban areas, we've seen supply start to accelerate pretty aggressively in these regions. And at the same time, that international travel, which was going to go to the big cities, is not necessarily appearing. And then some of the demand in these larger cities, not all of them, but in some of them, it's not maybe commensurate with the supply. So that's kind of an interesting. I'm looking out for that, and if that division is going to continue. So among the large city, particularly in the urban centers too, we've been seeing more of those last minute bookings as well. And I think that's responding to that sort of occupancy, which remains lower than it was pre-pandemic. So that is to say that there's a plethora of listings available in your large cities, so people can wait certainly to the last minute. So that's maybe the one real big division in performance that I would say is that the resorts are not growing their supply quite as quickly. They're seeing good unit level performance. Lead times are not going down as much. In the large city urban, we're sort of seeing a little bit of the other direction. The small city and the mid-sized city, they're still performing as far as growth. They're still, top of the growth charts, though they are slowing pretty significantly as well as they catch up to the relative size of some of the other location types that we've got.
Awesome. Great summary. So last question, sort of heading into the back half of the year, what's the one metric you're watching most closely? They're either weekly, monthly, our data, economic data, and what's giving you sort of and confidence that things are continue to hold up, or sort of watching for weakness that things might be turning?
Yeah, I'm going to be keeping my eyes peeled for this inflation figures as they come out, and I want to dig deeper into them too, because there are some goods that are more heavily affected by international trade than not. So being able to see how that's trickling through to the average consumer is going to be extremely important. And we're also going to be definitely looking at this occupancy as time goes on to verify our theory about the shoulder seasons.
Yeah, no, I agree. The inflation numbers, and we had talked about them a lot, and maybe 2 or 3 years ago when inflation was sort of ramping up and coming back down. Like, where are we going to see the impact of the Fed, and where are we going to sort of get the numbers down? And now that they're starting to tick up again, and sort of all eyes are on CPI, on what the Fed's going to do. Can they ease inflation further? And do they see sort of weakness across the market that and starts to concern them, where they have to and maybe further accelerate the reductions, or and do they get into this sort of stagflation scenario of low growth, high inflation, where it makes Fed policy exponentially more difficult.
Right. Or, we could even have a situation where everything seems to go well. Inflation stays low. We start cutting rates dramatically. There's a lot of housing inventory that's been built up. Prices are leveling off, if not declining. And we also do have some new tax incentives for commercial real estate investment. So, you might even, if inflation stays low, interest rates go down, that might be a good aggregate demand boost, but we also want to keep our eyes on supply, and if that's going to jump up and meaningfully affect unit level performance in 2026.
Awesome. Well, Bram, it's always a pleasure talking to you. I usually come out of these conversations feeling a little bit better than I was going in, and I appreciate your time today.
Absolutely. Always a pleasure. Thanks, Jamie.